Hi, this is Ian Coleman from PIA First. It's the 22nd of March. I'm going to look at Aussie dollar medium-term forecast. Had some very choppy price action in this currency pair, really for the last 7 weeks. If you look back at the weekly chart, which we can quickly do now, you can see that we've had this period of consolidation near this inside channel base, and literally for the last 4 weeks we've just posted spikes in both directions. We've posted mixed results, as I can see there, that we've got 5 up weeks, 4 down weeks, and we've really been consolidating basically in front of this key level, the 75, the figure level, and that's the target level, or the psychological level, or the level that the Royal Bank of Australia keeps on mentioning. Going into this week, we've got a bit of a mixed view. It's mildly bearish. This month's closing candle is going to be interesting. If we can get a close above 79.12, then we're going to get a bullish outside bar just under the 61.8% pullback level, and that could potentially project Aussie dollar to the upside. However, fundamentally, there's no real reason why we should see Aussie dollar strength, and technically this could well just be a bounce off this lower trend line, breaking down into shorter time frames. Okay, this is what we should say as well is this whole move from the highs posted in 2011 is still assessed as being corrective. Okay, the medium-term bias is still to the upside, but we think the scope for further selling before that bias changes. With that in mind, looking at the daily chart, we've got a 423.6% extension level, and that's not seen till 73.37. 423.6% is a common Fibonacci extension level for commodity-based currencies. Again, looking back to the daily chart, we've had inside bars or inside candles, haramis, for the last 2 days of last week. That's highlighting indecision. Really, for the medium-term bias to turn bullish is this level here. So we'd expect to move up, and if we get a move up, I should say, for this area, which is 79.12, to act as resistance, and then I'd expect to see a pullback in a right shoulder before we even attempt a more aggressive move to the downside. So our medium-term focus is still for lower levels. If we look here, we've got an ABCD formation, and again, it's not a million miles off this base. It's just under 72, the figure. However, obviously last week's price action with the FOMC has made the outlook a little bit murkier. We look like we're in an expanding wedge formation, which has a bias to break to the downside. The last move up was rejected above the 78.6% pullback level at 78.38. So it really needs to see a break and a move higher from last week's high to then focus up here before the correction lower. But really, our bias remains bearish. Unfortunately, because of the choppy and erratic price action last week, we're really going to need to see sort of a break of 76, the figure, to then focus on lower levels. Talking about our bespoke resistance levels, we have bespoke resistance at 79.14, so just above the previous high. Like I said, I wouldn't expect a break of that this week, or a break and hold of that this week. To the downside, 76.85 is a key level, and then 76.07, which is this lower low. So we really need to see a break of those levels to take us lower. Thank you.